February comes with several notable dates for the calendar. Valentine's Day, Groundhog Day, and who could forget National Golden Retriever Day, celebrated on February the 3rd. In marine insurance, though, February means one thing and one thing only: P&I renewals. For those of you not acquainted with the arcane world of protection and indemnity, renewals for the International Group of P&I clubs are due on February the 20th every year, specifically by noon. Now, this was traditionally the first date that the Baltic ports were free of ice, and while shipping doesn't halt for the seasons in the same way that it once did, the date has stuck. Presumably the noon deadline left sufficient room for a decent lunch afterwards. Anyway, to mark this significant deadline in everybody's diary, Lloyd's List's insurance editor David Osler has once again gathered executives of major P&I clubs and brokers to ask how the renewal season went. He's talking about whether they think the clubs should be handing back more cash to owners, and perhaps most importantly, whether the 170-year-old system can cope with an ever more volatile industry and some pretty hefty recent claims. Joining David this week is Jonathan Andrews, Chief Executive of Steamship Mutual, Tom Bowsher, Chief Executive of West of England, Thaya Cathrivol, Chief Underwriting Officer at North Standard, and Stephen Hawke, Managing Director at P&I broker Lockton Ferrari. The first voice you're going to hear is David's.
Well, I'll start with a question for the club representatives. A nice and easy one. Just tell us about how your club came through the 2025 renewal. Did you get additional tonnage? Did you increase your premium income? Who shall I start with? Jonathan.
Thanks, David. Good morning, everyone. Yes, it was, as usual, a very work-intensive period. That's normal, I think, for all of the clubs. The owners at this year's renewal, I think, were looking at a difficult year ahead. I think that they are expecting all of the geopolitical turmoil to infect their businesses, and therefore they don't like situations where their overheads are going to increase and their premiums rise on the back of general increases. So there is resistance. However, having said that, the majority of the members, the huge majority of members, do pay the general increase in some shape or form, some more, some less, a lot at the general increase. And that was our experience again this year. It's part of a process, David. Our underwriting is very cumulative. It's impacted by what happens during the course of the year, the decisions we make in the course of the year, and then each renewal builds on that. So it's not a moment in time that determines your future. It's part of that process.
Right, but you picked up tonnage and premium volumes, presumably?
We picked up tonnage. We lost tonnage. Maybe I shouldn't use the word loss. I mean, there were members where we couldn't agree terms who moved on. And equally, there were members from other clubs who joined us. For every new member that joins you're regarded as a very positive thing. But I'm sure many of the clubs that lost that business would regard it as a positive for them too. So it's very much in the eye of the beholder.
Okay, how about you then, Tom? As we reported in Lloyd's List, you seem to have picked up a couple of new accounts.
Yeah, we did. Much like Jonathan, our renewal was quite intensive. I do think that it was a little slower than maybe previous years. I think that's partly because I think, as far as we're concerned, the policy year was sort of very much divided into two halves. The first 6 months of the year were quite positive, I think, for the group. The pool was pretty inactive and where we thought it would be. And our own claims experience was also relatively positive and slightly ahead of forecast. As we then went into the second half of the year and into the board meetings where we determined the strategy for the renewal, I think the whole industry started to feel a slight increase both in severity and frequency of claims across the group. And I think that largely did shape our renewal. So yeah, we did have a positive renewal. We went for a 5% general increase, which was on the lower end of the scale. As Jonathan says, the freight markets towards the end of the year also took a bit of a tumble and have continued to be quite testing for some owners. Rates are below OPEX in some sectors, so that did play a part as well. But we did attract quite a bit of organic growth to the club, which I think is important. It does show and demonstrate the club's doing a good job and there's confidence in what we're doing. And yes, we did also attract a few new owners and new members to the West too, both on the owned, fixed and on the chartering side.
Okay, and I've read the press release from North Standard, and it seems you did rather well. Is that the case, Thea?
Yeah, pretty much the same, David. Opposite to Tom's experience, we had a fast start to the year in terms of claims. The first 6 months were busy for us in terms of large claims, and better experience in the second 6 months. The 5% general increase was pretty much in line with most clubs, and it was difficult actually this year getting that general increase through the door, because of exactly those reasons. The freight markets in certain sectors, bulkers, containers, are expected to drop in 25, and ship owners are naturally anxious about what's around the corner. That made it difficult. But be that as it may, I think there was strong support from the members. We had a retention rate of in excess of 98%, and we put some tonnage on at renewal as well. But a lot of that work in terms of growth came during the year. Organic growth from existing members and some new members who chose to join us during the year as well. So yeah, we grew by about 10 million tons, which seems to be pretty much what everyone's doing at the moment.
Now, finally, I'll turn to Stephen for a broker's take on this. I mean, Stephen, you've complained once or twice that the documentation process has been particularly tardy this year. Also, one of your colleagues, Pippa Atkins at Lockton, has said in a short report that maybe the clubs weren't getting everything they were asking for. Maybe they were probably picking up 2/3 of the headline announcements on rate hikes. I mean, is that pretty much how you found it from your point of view as a broker rather than a club?
Firstly, of course, we never complain. We just make constructive comments and criticism. But in terms of the overall, what we hear anecdotally as to where maybe the clubs were in terms of achieving their general increase and across the board as a whole, as Jonathan said, some will have paid less than general increase. People with bad records will have paid more, but there was pressure. And I think at the end of the day, if the overall rough market increase was around about 5%, we suspect, talking anecdotally to people in the clubs, they probably got to 2/3 of that. But if you include terms, by which I mean where owners opt to take higher retentions and get therefore a concession on that, that's probably near 75% of the overall general increase, which I think in the current circumstances isn't bad. It was not a soft market. It was not a market where clubs were rolling over and saying yes, yes, yes. It was a fairly disciplined market, and I think it's probably not a bad result.
Turning now then to free reserves, I seem to have seen in one broker's report that International Group's free reserves are collectively at $6.2 billion, which is an all-time high, and some clubs seem to be making more money from returns on investment than they are from underwriting vessels. So there is a school of thought that clubs should be giving some of that money back. And I know, in fact, that is what Steamship does. You tell us about the policy and the advantages of it, of giving cash backs as you see it?
Well, it's as you say, it's a policy driven by the situation we're in at the moment. We have a strong balance sheet. And just picking up on your comment, we're not aiming to make a profit or a surplus from our underwriting. But naturally, when you hold a balance sheet with assets of $1.5 billion, even with a very conservative investment strategy, you are going to return quite significant sums back to the club. Those returns, as I say, if you've got an already very strong balance sheet, are available for the board to return at least a part of that or a large part of that back to the members. it's the sort of the simple end of the process. The hard thing is getting yourself in a position where you have that strength or in the balance sheet. So yes, it's part of our policy. The situation again this year will be that the investment return will significantly exceed any relatively small underwriting deficit that's incurred because of the excess on the pool or the over budget on the pool. So the situation will endure, we think, and that will be something for the board to look at in the aftermath of the audited results coming out in the spring and summer. I think it has helped our renewal, by the way. I think you are always in a slightly better position if you've got something to give when you're asking members to pay a little bit more premium. I think it has helped sweeten the pill, so to speak. So I think that has been an advantage at an operating level as well. I think it has contributed to our recent experience.
Okay, what about you, Tom and Thea? Are you envious of clubs that are in a position to offer members a rebate on renewal? I mean, is this something you'd consider yourselves?
I don't think the word is envious, but of course we're mindful of those clubs. There are 3, I think, that this year that gave back capital distribution to their members. It's something that our board reviews annually, and I would be lying if we didn't have a discussion about doing something similar at our board meeting in November with our board. Our board's clear objectives are to continue to strengthen the solvency and capital position of West. We are comfortably above the requirements that are set within the Solvency II regime, and we are above the AAA capital requirements on the S&P model, and we are A-rated with AM Best. But we feel as a club at this moment in time, or at this last renewal, it would have been premature to give back capital. So our board took the decision not to do that. It does, as Jonathan said, I think put those clubs that are giving back capital at a slight advantage when it comes to negotiations. And I think any club would be lying if they said it's not referred to in renewal negotiations, both by owners and by brokers from time to time. When we're negotiating or we're looking at placement of tonnage, movement of tonnage, etc., throughout the year, and also at the renewal, particularly when we're all renewing our contracts. So it's something the West Board is reviewing. I'm pleased to say that we have exceeded our objectives at this renewal, both on premium income, tonnage, and the capital requirements. There are pressures, as I said a moment ago, on the group, and I think we'll talk about that in a moment, with the claims environment changing. So we have to be cautious with where we are. The club is in a very strong financial position, but we feel at this time for West that we would like to strengthen the balance sheet a little bit further before we consider that. But we will continue to monitor it, and we'll look at it again as the year goes on now into 25. And we'll see how we fare towards the end of this year as we enter the 26th renewal.
I would echo that, Tom. I think that the reality is the clubs that don't return capital obviously look at the perceived advantage of being able to reward members with some sort of return, and how that might be able to help with renewals on occasion. It's not always the sole ingredient in concluding a renewal for a member, but it might be advantageous. In our case, our board have adopted the strategy that the larger scale that we have protects us and our members against volatility. So that's a big book of business across mutual P&I and diversified lines. And with that comes the capital requirements that we have, coupled with the way in which we invest our funds. And right now, North Standard are not in a position to return the surplus capital that we have, because the board have decided very much the margins of surplus capital that we need to retain to protect against ongoing volatility. And I think this year in particular, as claims appear to have returned to what I would term normal levels, a normal baseline, warrants that continuing conservative attitude towards volatility and future volatility.
Stephen, you're surely going to tell me that clubs have got too much money and should be giving some of it back to their hard-pressed members.
No, I'm actually not going to. I think there is a body of thought that believes that, but we certainly don't. I would just echo that those clubs that do give a capital return or have given a capital return, without doubt, it does make the renewal negotiation a little easier, and it makes it probably easier for the club with a capital return to achieve the level of increase that they may want, because, you're taking with one hand and giving with another. But owners aren't stupid. I mean, they will say, and did say to us, okay, so we're getting this money back, which may indeed cover the increase that we've got, but our rates have gone up and those go up in perpetuity and they get compounded each year. I think the interesting thing would be is if the world was really stable and in the future all 12 clubs were able to give capital returns, and how actually that would actually dilute things and become, oh, right, okay, so what? But at the moment, I think it is an advantage in terms of those clubs that give a capital return, and the volatility that sits out there, which I'm sure we'll go on to, particularly relating to the pool, does mean that stability is absolutely important. And those free reserves, in whole or in part, are very much there to buffer a bit against that volatility. So no, I don't think they have too much money. And when they do, yes, it is probably time for an individual club to give a capital return. But as a whole, the clubs do not, in my opinion, have too much money.
Okay, then there's a matter of underwriting performance. I mean, clubs are obviously marine mutuals in the happy position of not having to profit maximise, but on the other hand, you can't lose money over the long term. You've got to keep more or less at break even. Now, I've seen predictions that many clubs will be looking at negative combined ratios this year. Even though we're not going back to the 130 or 140 that we sometimes saw a few years back. Do you think clubs are getting pricing right?
Well, David, if I could, I think we work in a very unpredictable environment. The P&I clubs were formed because of that unpredictability, and that continues to be the case. So we will never get the pricing right. If right means 100% every year, that's simply pie in the sky. So we are always going to be a little bit, and I use the word advisedly, a little bit. We're aiming to be a little bit wrong, either one side of the line or the other. And when in the last couple of years things have been quite benign in terms of the large claim experience, we at Steamship have been a little bit below the line. We've been making an underwriting surplus. And when claims are unusually high, which is certainly the case this year, but was also the case in 20 and 21, then the underwriting performance suffers. That's completely predictable and completely to be expected in our environment. And I think that's where, as Stephen was saying, it's where your balance sheet is there to support you. You want to have that excess capital to take the bumps in the road when we have, as we are at the moment, a very high claims year for the industry. So I think that's where your stability comes. It's your capital margin that is important to deal with volatility. From our point of view, we don't aspire to try and gain stability through scale, through size. We aspire to have stability through the strength of the balance sheet.
I wouldn't mind just adding my two pence here, because this is a pet subject of mine that annoys me a little bit. And what everybody said is absolutely fair and fundamental. But when we talk about getting the underwriting right, to me, that's getting the day-to-day underwriting right. That's what's happening, if you like, on the attritional, smaller and medium value claims. That's where, if you've got a bad underwriting policy, that's where you'll probably see the effects of it in terms of true combined ratios. The effect of large claims is sometimes overlooked in the sense that when we talk about these combined ratios, we ought to almost factor out the very large pool claims from it to understand the inherent underwriting result that's going on beneath that surface. The point being is, we've had these large pool claim spikes over the time. Every time there is a spike, people talk about this is the new normal. But I go back far enough that if you adjust for time value of money, there were worse years than this than in the past. And then you get a benign period. That makes it very, very difficult to budget. And it's certainly not a reflection of any individual club's underwriting standards that they happen to be hit by a spike on their club of additional pool claims. They are random. What is different about pool claims to our mind is that the number of them have decreased since 10, 15, 20 years ago, quite substantially. There aren't many. They're just above mid double digits. And it's the values that have gone up. And being able, as a club, to be able to predict that is almost impossible. And I think it's 16 pool claims, somebody will correct me, this year, out of 20,000 ships that the International Group write. Well, that's 0.1%. There is no ability as an underwriter to predict the fact that you or the clubs as a whole are going to be suffering more or less in any one particular year. And it goes back, therefore, to the point that free reserves should be there in some parts to stabilise what is inherently a volatile situation. And we move forward into the new year and look already at Renewal 2026. Clubs will be making budgets based on recent history and the current environment. But another good pool year sets everything back again, if you like. It's very, very difficult for clubs to do this in any meaningful sense. So I would go back to Jonathan and just say, yeah, this is a process. Over time, it's got right. But being able to predict the short term is virtually impossible.
Right. I mean, Stephen, thanks for those comments because they dovetail neatly into the next question I was going to ask, which is inevitably the state of the pool. As you said, 16 notified claims as of February the 20th, and people have told me that there are several more in prospect. Pool is looking at a deficit that could come in as high as 750 million on some estimates, which is substantially in excess of the previous record year. So the obvious question is, can the international group system take this in its stride? I'm going to start by asking Thaya about this, if only because North Standard account for 5 of those 16 claims so far. I mean, obviously no one's suggesting anything amiss. That's just a run of rotten bad luck. But how do you see things, Thaya?
Yes, that was our first 6 months, David. Unfortunately,
5 in 6 months.
Yeah.
Ooh, ouch.
It's actually 4. The 5th one is one that's probably going to come under the 10 million, but it's reported to the pool anyway. No, I think as Stephen mentioned, we've seen this before. It's not new to us, and it's a function of a bunch of factors, including freight markets and port congestion, vessel utilization, and also an aging fleet. I think we often forget that with shipbuilding capacity centered around container ships and gas carriers, we've got an aging tanker and bulker fleet, which comprises the majority of tonnage in the international group. And that's going to feature as well, I think, in claims going forwards. And that these are the predictions that we need to try and make, which is incredibly difficult to make from year to year. But the sense, certainly that I see, is that the claims picture isn't going to improve, not while these factors are at play, coupled with geopolitical events that force ships to perform much longer voyages, that are also contributing to this spike in claims.
Tom?
There is no doubt that whilst pool numbers are potentially falling, I'd say the average probably around 20 pool claims a year, 20 to 25 on average over the last, say, 10 years. The severity, I think, has increased and claims are becoming far more complex. The environmental challenges of wreck removals, etc., can pose all sorts of complications and additional cost to clubs and those involved in clearing up and removing vessels and dealing with pollution matters, etc. So as Thea said, larger ships, older ships. The container trade is with misdeclared cargoes is becoming a problem. The larger car carrier vessels, etc. So these are all changes that the clubs need to adapt to, and I think we are, and I think we do a very good job of doing that. And we provide excellent service and technical knowledge and support to all of our members across the industry. But these are costs that we have to accept are there. Severity of claims is, and the complex nature of claims is something we can't overlook, and it is becoming a larger part in some years at least of our overall claim spend. But I don't think we should be intimidated by this. I think this is exactly what the pool is there for, and exactly what the system represents, and we should be embracing it rather than trying to walk away from this. I think that the club system is there to be protected.
Finally, let's end with some predictions for next year. I mean, I know nobody is going to want to be hard and firm about where pricing might be for the 2026 renewal, but given that there's still the best part of 12 months to go, I mean, is it fair to say the pressures are going to be on the upside for the 7th successive year?
Gosh, I don't know. One can say, David. I mean, I think we are, as Tom and Thea and Stephen have reflected on, we're in for a difficult round of results reporting for the 24 financial year. But as we've also said, this year it's possible that we could have a reversion to a low pool, and that would drive a lot of the discussions at the October round of board meetings for the club. At the same time, we're all benefiting from an investment conditions in the last 12 months that have given us very healthy returns. So it's quite possible that there'll be further rounds of capital distributions from some clubs. I think it's extremely difficult. The world fleet's growing, so we're all going to experience some tonnage growth to a greater and lesser extent. I think we have more turbulence, of course, to deal with the prospect of disturbance in world trade through sanctions and tariffs. And as Thea said, we have an aging fleet to deal with, and we have a large proportion of the tanker fleet which is now subject to sanctions. And the developments in that regard will have a bearing on both our potential exposure, but also the way that the entries of each club will be comprised.
No one's got a crystal ball. It's very difficult to predict. Every year is different. As Jonathan said, if the pool reverts to a lower level, that will help. If investments remain strong, whilst that's not focused on the technical performance of a club, that of course helps and will help strengthen a club's capital position. I think also the influence of boards is possibly overlooked. We have a very positive and constructive relationship with our board, and sometimes they disagree, or maybe frequently they disagree with the managers. So how we view a particular year and what we need to do may differ with our board. So it would be unfair for me as representing the managers to predict how I see the year without consulting the board and presenting figures both on the year that's just gone and how we see the year with our forecast going forward. What I would say though is, as recent events in the industry, and then particularly in the P&I market, has shown, sometimes what clubs are required to do and how they approach renewals and technical underwriting is sometimes also taken out of their hands. The greater influence of rating agencies and the solvency requirements that we're now the majority of the clubs are asked and expected to meet can also dictate the underwriting strategy of a club. So there are many factors at play here. But I am prepared to predict that I think there will probably be more increases at the next renewal. And I'm not just speaking for West. I just think from what I hear anecdotally across the market, and what I'm seeing and what I saw prior to the 2 years of benign pool claims, I think there probably are still some underwriting issues. What that will mean, and will general increases be there, and what form and how big will they be, and will there be more capital distribution? I can't say, but I would predict that there will probably be further increases needed, certainly in some parts of the group at the next renewal.
Thea.
I think that's a pretty safe bet, Tom. I think the reality is that combined ratios are probably going to be in excess of 100% when the clubs eventually start reporting mid-year, and it is all about claims and the fact that we can't predict how that's going to develop this year. Although the mood music, certainly from the way in which the performance has been through 24 and early into 25, would suggest we've got a continuation of last year's experience to an extent. And then it's down to investment returns and whether we have and will continue to experience the returns of 2024. On our side, the fact that we have a diversified book of business gives us some protection against the volatility in the P&I space.
Last word to you, Stephen.
I think always the broker should have the last word.
They always do.
They always do. I just want to make 2 quick points. I think that the geopolitical situation, referring to Thaya's comments about investment returns, will always be something that's going to be sitting out there in this unstable world. I think we all, from a humanitarian as well as a commercial point of view, hope for a resolution in Ukraine. But wars and strife seem to persist everywhere at the moment. I noticed that Trump has started to ramp up sanctions, and I think we can see a lot more of that, making everybody's life a lot more difficult. And that uncertainty, in a greater or lesser extent, will have impact on trade. And if it has an impact on trade, it will also have an impact on things like investment returns. But given and listening to these politicians making diplomatic non-answers to a prediction, from where we're sitting here, I would say, from what we know on this particular day and absent black swan events, yes, it'll be another 5% on an average across the group, unless something untoward and unpredictable happens.
That's where we're going to leave things this week. But if you enjoyed that, then you really should be checking out David's work at lloydslist.com. He really is the best in the business. And, of course, you can read all of David's coverage of the insurance market, as well as the most important stories shaping shipping on the Lloyd's List app. That's it for this week. We will be back, as usual, next Monday. Speak to you then. Goodbye.